Hello everyone, welcome back to another update here with our Lunch and Learn webinar series. I'm Mayur Thaker. I am an analyst and co-portfolio manager here at Zacks Professional Services, and this is an update on two companies that we just recently added to our flagship model portfolio, the Zacks Earning Certain Proxy. That is CGI and Gartner. These are two bellwethers within the IT services space. And these two companies, the reason why we added them is because we do believe very strongly that they are emblems of quality. And that is the central strategy and idea behind the Zacks Earning Certain Proxy. And so let's take a look exactly at what these two companies do. This is a quick update. We've already actually went through this in a prior presentation, but just as a recap, what is quality? How do we build the portfolio that goes into, and what the criteria are that goes into the portfolio construction process? We have four pillars of quality: high and durable earnings linearity, high and durable earnings growth, high and durable return on invested capital, and high and durable free cash flow conversion. The common ground between all four of these is that they have to be high and they have to be durable, both. They're both, having both is very, very important across each of these four criteria. And we have found that companies that meet these criteria over long periods of time tend to be industry leaders. They tend to have very wide moats, meaning it's very difficult to replicate what they do by the competition. And ultimately, they can repeat the earnings growth year in and year out, regardless of the macroeconomic cycle or the macro conditions that are in play today versus over time. So that's how we define quality, is consistency across all four of these metrics. And so how do we determine that? When we do the business analysis, we look for durability. We want to find companies that are solving some pain point or are addressing critically required areas. We want companies that cut costs, ultimately that creates value for customers. We want something that increases utility. Do they drive ROI? That's a very, very important question, especially if it's a B2B company that we own. Do they have recurring subscription or lease revenue? That's also a very strong indication that they can continue and repeat the earnings that they have reported in the past. Do they have strong brand value? Research has shown that brands drive returns on invested capital for a very long time. So brands create economic value, which then translates into market capitalization over time for shareholders. Do they have a strong brand? Do they have a good product experience, customer service? And then lastly, the most important is, does management have a track record of strong capital allocation? Are they investing in themselves? That's a key question to ask. So combined, these factors tells you, they together tell you about the company's ability to continue high performance into the future. So the companies that we own in the Zacks Earning Certain Proxy have at least one of these pillars of durability. And preferably more. So let's take a look at CGI. Again, we've already gone through this, but this is just a really quick recap of what these two companies are. CGI is an IT consulting and systems integration company that represents about 45% of their business. This is when companies need support with regards to taking on new projects. Let's say a company expands into Europe or into Asia, and they need the assistance of somebody to create the IT infrastructure for them to set up their offices and get going with it quickly and seamlessly. That's what this division does: IT consulting and systems integration. And then managed IT is the other part of their business. That's 55% of their revenue. That's the ongoing support. That's the ongoing management of that IT infrastructure that was pre-built. And that's the area that is recurring in nature. That subscription or contract revenue is a huge part of why CGI was added to the Zacks Earning Certain Portfolio, because that is the area of the business that is recurring in nature. and it has very low, cancellation, meaning very high client retention. So CGI, they've built deep industry and technology expertise. They specifically focus on industries like banking and insurance, government, space, manufacturing, retail, transportation, and many more. So they have obviously an IT proficiency, but then they also know what the industry specific needs are for these particular industries, and that's where they've built most of their expertise in. So again, earnings linearity, that's what we love to look at, and earnings growth together. Those two kind of go hand in hand. Earnings growth linearity, you could actually combine those two into one, but you can see exactly how that's been over time, and really since 2014, it's become very highly linear ever since managed IT has taken over most of their revenue mix. And that's the part of the business that is much stickier in nature and recurring in nature. So very high business visibility into the future, very strong earnings growth over time at about 10 to 11%. Again, that's excellent. We found that companies that can sustain 10 to 15% earnings growth, that's the ones that can last for a very long time, especially as they generate significant free cash flow to buy back stock, and that helps support the earnings per share growth rate. That definitely adds value to long-term shareholders over time. Again, they're very, very profitable. You can see the ROIC at well north of 14%. That we love to see that, because that tells you how attractively is management deploying capital, right? This is capital efficiency is very key. High ROIC businesses tend to have high free cash flow. So if you just think of it, let's say two companies, they both grew, let's say their net income by $50 million, and but one company needed $100 million of investment to get that $50 million growth, and the other company needed let's say $50 million to generate that same $50 million of growth. And company B, all else held equal, will necessarily outperform because they had to put up less capital to generate the same amount of growth, which means that their free cash flow is going to be bigger than the first company. So ROIC is very important because it tells you how much they're earning per dollar of capital that they have to invest. And so higher ROIC companies tend to outperform, especially specifically if they can sustain it for a long time, because they have excess cash flow that they can then use to either pay dividends or buy back stock or make acquisitions or pay down debt. All four of those activities add to shareholder returns over time. So we love high ROIC businesses. This is why ROIC is one of the four pillars of the Zacks Earning Certain Proxy portfolio. You can see free cash flow conversion is the fourth principle. This is very important as well because it tells you the quality of the earnings that they're reporting. You can see GIB as well above 100%. Gartner is a similar company, technology consulting services. They're similar to CGI, but they're different enough for us to like to own both, because Gartner, although they are squarely within IT services, they focus mostly on research. So Gartner, in a way, kind of competes with sell-side analysts in that sense. They focus not on companies and valuation, but they focus more on research to inform non-investors, although their research is used by investors as well. But their target market is industry players, businesses, business owners, C-suite executives, to know what products out there are the best for what they need. So Gartner provides deep industry research across things like cybersecurity, consumer electronics, everything like that. Even AI now, in emerging areas of AI. Gartner is a leader, a long-time leader in providing probably the best research that is available out there. That includes among sell-side research, that includes among other competitors. Gartner is the number one company and the most trusted company, a great brand that C-suite executives go to for trusted research in knowing what the best products are for any given sub-industry group within technology. And then they also put up a lot of events as well. That's actually a big part of their revenue stream. Gartner hosts large conferences and trade shows, and all of the top industry players love to attend these conferences, and that's also another big part of how they generate revenue. But again, they are a significant leader when it comes to technology research, publishing research. So we love to look for that brand value and deep industry expertise. It's very difficult to beat that. And you can see that they have had a lot of, very stable growth, and it's been amazing, during the post-COVID era. You can see there's a little bit of mean reversion there going on, but we're not, concerned about that. You can see the ROIC has been tremendous at, north of 25%. Free cash flow conversion similar to CGI at well above 100%. We love that. Gartner has a very capital-light business model, so they don't need to invest a lot to generate incremental, profits. So that means that they are a very scalable business because research is scalable like software. So once they have, assembled research, they can scale that with very little incremental capital needed for that growth. So whenever you have growth with very little incremental capital, that means that you have very strong free cash flow growth, and free cash flow growth is the ultimate metric for shareholder value creation. That leads to share buybacks and dividends, which they don't pay, but share buybacks have very much been a part of the culture of Gartner. And here you can see how they have really reduced the float significantly over the years, and that's going to continue for the foreseeable future. So the Zacks Earning Certain Proxy is a list of 76 such high-quality businesses that exhibit these types of high-quality characteristics, namely earnings linearity, earnings growth, return on invested capital, and free cash flow conversion. This is the 4 pillars of quality and long-term value creation that we love to look for. So these are the types of companies that we hold in the portfolio. But now let's take a look at how these two companies did with regards to Q1 earnings. So here I have pulled up CGI's investor deck for Q1, and I just wanted to point out a couple of things. So CGI, the earnings report was well received by investors, but there might be a little bit of a bounce as well because the stock has been oversold. Heading into the earnings report here, you can see that if I were to pull up CGI here in TradingView, it's their ticker is GIB, not CGI. I think everybody makes that mistake. And if you look at it, the stock has been under pressure heading into the earnings report, and here you can see that pop today of about 3%. So the stock was probably oversold and due for a bounce, and so when the earnings result came in, there's a little bit of that oversold nature, being corrected back to the upside. But CGI, again, for the long run, it's a great business to own because of the fact that they have highly stable and highly visible earnings growth. But I think the reason why the stock has been under pressure, even though it's reacting favorably to the report today, is because the revenue has been very, very muted in the most recent period. You can see that their revenue growth is only 0.7%, and actually it's been 0% on a constant currency basis. So basically flat growth on the top line, and that's kind of why the stock has been under pressure, but we still think that in the long run, since we manage this portfolio with a long-term focus, greater than 5 years, we think that this is still a great place to be, especially at its current valuation. Remember, GIB only trades at about 17 times earnings, which is great because that's a discount to the market, and yet it's a very high quality company with highly recurring revenue and therefore recurring earnings. So we love to see that. You can see that net earnings actually grew by 11%. So even with flat revenue growth, between share buybacks and margin expansion, which they continuously do through a ever-shifting mix into the managed IT side of things, you can continue to see margin expansion because of that. So we'd like to see that, continue. So that's that. That was about 4% growth year over year on diluted EPS. We like to see that continue, especially for a company that's priced at just 17 times forward earnings. So we think that the valuation is attractive for such a high quality company, even if they don't grow that much. Because remember, it's not priced for high growth. So it's okay to have, flat growth if you're paying a very reasonable multiple for very steady earnings growth of something around 10%. And that's, I think, exactly what they're going to clock in at for this year. So again, CGI has 90,000 consultants and professionals all throughout the world. They generate revenue from every region of the world. I'd like to see that here. And this is where I like to look at as well. What is the revenue mix? 54% managed IT, 46% business and strategic IT consulting. That is, where most of the growth is, but managed IT is where the stability comes from. So that's also what I'd like to see as well, is I like to see that part of the business become a bigger and bigger share of the pie, because that's where the stability and therefore the confidence in the future comes from, especially for a company that trades at just 17 times, forward earnings. It's a very, very attractive, multiple for a company of this quality. And then also go down here, you can see that the total bookings for Q2 fiscal second quarter was 3.8 billion. Again, bookings is very important because that tells you, how much future revenue that there is to come. Because remember, they can't obviously when bookings happen, they can't necessarily recognize that as revenue immediately because those are dependent on deliverables. So these are contracts that are signed or agreements, letters of intent that are signed with customers, but they can't yet recognize that as revenue until they deliver the services that they signed up for. But 3.8 billion of total bookings, that tells you the backlog. That's very, very good to see. 31% of that is new business. 69% of that is expanding existing business with existing clients. Again, very healthy overall results. This is interesting right here, the segment breakdown. So the biggest, if you're curious, the biggest source of revenue comes from Europe, Western and Southern Europe. That's $682 million of revenue for Q2, their fiscal second quarter. U.S. Commercial and state governments are number 2 at just under 600 million. They also contract with the U.S. federal government. That's about just under 500 million. But interestingly, it's the Asia Pacific region that's actually the most profitable, because you can see here that that region has 31% adjusted EBIT margins. So although Western and Southern Europe is the biggest source of revenue, it's not the most profitable revenue. The Asia Pacific revenue is by far their most profitable at 31%. And so their aggregate across the board margin is about 17%. So again, very high quality, data overall. We like to see that kind of stability. And here's the other thing that I love to see. I absolutely love it when management, not analysts like us, not investors like us, but when management brings your attention to things like return on invested capital. That tells me that they have the right focus in mind, that they understand that capital efficiency matters. And so when they report to you their own return on invested capital, that means that management is thinking in the right mindset, with the right mindset, that capital efficiency is what they target. And that is exactly why we own this company in the Earning Certain Portfolio. Because again, we love to see earnings stability, earnings linearity, consistent earnings growth, as well as high and durable returns on invested capital. And there you can see that they're at 15.9% versus 15.6% in the prior year period. So very, very high quality stuff. Here you can see a chart of the revenue that's been flat. But again, in the long run, we're not so concerned about how it has performed in the short run. But in the long run, we think that there is going to be continued tailwinds with regards to what they do, as well as continued favorable mix when it comes to revenue. So therefore, even though top line has not grown much, you can see that earnings before income taxes have continued to trend in the right direction, upward. So here you can see that their margin kind of bottomed out last quarter, and it seems to be back on track, back to long-term trend, and that trend has been up over time. So that's exactly, again, what we like to see. Therefore, that leads to that steady growth in the bottom line and the steady growth in free cash flow. So investors liked this report. That's why the stock is up today. They just reported last night, and the stock is up today. But again, that's within the context of a pretty bearish downtrend that really started in March of this year. But I think in the long run, this is a high-quality company that we love to continue to own. And this dip in the stock price, I think, is just another good buying opportunity overall. The other company that we love is Gartner. Gartner, again, is just absolutely phenomenal. Their business attributes, their ROIC, and just the brand that they've built, their reputation that they've built across industries, where companies have really depended on and trust their independence and trust their insights to make the best decisions for their companies, their respective companies. So again, like I mentioned, Gartner technically competes with the sell side on technology research, but the difference is their client base. Whereas sell side analysts, their customers are the buy side, right? The investors, like you and I. Gartner, their clients do include the buy side, but mostly includes decision makers at corporations, corporate clients. And so that's the key difference there, but they really do the same thing, which is to provide deep industry level research. Here is their Q1 results, and the market did not like it very much. You can see that the stock actually declined on this report. It's been a pretty big downtick today, or yesterday it was, and a little bit of a bounce back, but the market really didn't like it, and it's probably because they did not like that top line growth there. It was just about 4.5%. That's been trending lower over these last several quarters here, and let me actually find that chart that they showed about that. I think it was in this one right here. Let's see. They actually provided two different PDFs here. I'm just trying to find the one that talked about their top line growth, but basically, let's see, it's not here. But basically, this growth rate at 4.5%, investors didn't like that because it's been trending lower consistently. Right here, I guess this is the table that I was thinking about. You can see the year-over-year growth last year in the same quarter a year ago was about 11.6%, and it's really trended lower every single quarter at 9.2 year-over-year, 5.8, 5.4. Now we're down to 4.5%. So this is not a good trend in terms of their revenue growth, but remember, growth is definitely important, but I always emphasize above growth is sustainability of the bottom line. And you can see that the free cash flow has continued to grow over that time period. You can see that here. Versus Q1 of last year at 144 million. Now it's at 166 million. So, more than growth, I like to look at free cash flow, more than top line growth, I should say, or even margins. I like to look at, how free cash flow per share growth is looking like. This is aggregate free cash flow. But you can see that the last 12 months of free cash flow has also been steadily growing. Remember, as companies grow free cash flow, they can increase their share buybacks and also provide additional flexibility with regards to debt pay down, as well as making strategic acquisitions. So I'm not really bothered by that deceleration of growth. This is an area that will wax and wane. But the bottom line, because they are so high margin and so high ROIC, the bottom line will not have too much volatility. So to me, this decline in the stock price post Q1 earnings is pretty much just a valuation reset rather than something that's happening with their core business fundamentally. And the other thing too is that I think the market also didn't like their forward-looking guidance there. The guidance for this year on free cash flow is 1.08 billion. That was a little bit light. Adjusted EPS of $10.90. That was a little bit light. And so, I will admit that IT, heading into the report, was trading at a premium price. You can see that they were trading at close to close to a 40 PE. So it is on the high end. It is priced like a technology company at a forward PE of 40 or 35. Now it's 35, but it was 40 not too long ago. And here you can see that the forward PE multiple as it changes over time here, down to a 35 multiple today. So this downdraft here has been kind of a multiple compression to reflect decelerating top line growth. But again, as the company continues to generate increasing free cash flow, there will be, support for the stock at some point. I'm not sure exactly what that point is, but, I wouldn't try to, time it with this one. As a company that can continuously compound, free cash flow and earnings, this is a company that, will, continue to support the stock price with tactical and strategic share buybacks. This is the research segment right here. You can see that division has been accelerating. Their contribution margin has also been accelerating. This is a great trend. Remember, research is their core business. That's where most of the value comes from. Is their research, and they also put on events as well. Conferences is what they call it, the conference segment. That part is a little bit up and down. It's kind of flat. That's usually not where most of the growth comes from. But conferences are a big part of the company, not because of how big the contribution to revenue is, but because conferences is where their visibility comes from. That's where they become a very sought after brand. Everybody wants to be a part of a Gartner hosted event. Everyone wants to have a booth at one of Gartner's trade shows or conferences. Everybody wants to be a keynote speaker or a speaker at one of these conferences because they know that these conferences are attended by C-suite executives. They are attended by ultimately their customers, right? The customers of technology companies. So conferences are really what builds the brand. And the branding is really why Gartner has been so successful, on top of the fact that they have decades of industry level experience, and they hire and retain some of the best industry consultants, and it's really been a revolving door as well, where individuals who have direct work experience, executive level work experience, or manager level work experience, they would also become consultants for Gartner. So that provides direct hands-on experience as a part of Gartner's core team of consultants that write research. Here you can see their share repurchase program that's been continuously going. That's exactly what we love to see as well. We love, as long-term investors, we absolutely love companies that buy back their own stock. Free cash flow conversion, like I said, for CGI, I absolutely love it when companies, managements themselves highlight these principles like earnings linearity, earnings growth. Well, everybody highlights earnings growth, but very few people highlight ROIC and very few people highlight free cash flow conversion. So remember, that's a big part of our investment philosophy. Going back, to this slide, return on invested capital and free cash flow conversion are numbers 3 and 4 of our 4 pillars of quality. And so when companies talk about this themselves, you can tell that that's where their head is in the right place, because they know exactly what quality means. So free cash flow conversion has been, excellent in that sense, at 134% in Q1. Very, very solid number. And then I also like to look at this supplemental PDF that they put out here. They actually put a separate PDF just on their free cash flow. I love that. Nobody does that. Very few. It's very rare for companies to put together a presentation specifically on free cash flow of the business. So I love that. So you can see that their business model drives strong free cash flow, and this is how they do it. They have strong recurring revenue. Again, that's a trigger word for us, because we love recurring revenue. That's how earnings linearity is determined. When you have recurring subscription revenue, that's what leads to earnings linearity, very stable earnings growth, like you see here for CGI as well as for Gartner. High renewal rates, that tells you that they have a very, very strong moat, meaning it's very difficult for competitors to poach their clients. Very low capital intensity, that's music to my ears, which means that they don't have to put up a lot of incremental capital in order to generate growth, which means pure free cash flow growth. Reinvestments for growth, so they can use this free cash flow to buy back stock as well as do strategic M&A. Recurring revenue is 76% of their total revenue stream. Love that. Absolutely love that. This is literally quality defined. They have a very large total addressable market, 200 billion. So that tells you what the growth potential is for them. So as long as there's a big runway for growth, we can have reasonable confidence that they can continue to tap into that for new opportunities to expand. Again, high renewal rates. I just love it when companies call into attention their retention rates, because again, that contributes to certainty into the future, whether they can repeat their revenue and earnings. Very strong contribution margins here. You can see that this is exactly what we like to see, where new revenue generates very, very high margins, because this is all operating leverage, right? When you have new revenue but not much new expenses to go with it, those contribution margins become very, very high. And that's how you can see that here at 67%. Off the highs here, but again, this is not really a concern. You're just looking at it pretty short term over a 4-year period. But overall, very, very solid stuff. Upfront invoicing, that's very good for operating cash flow. Very low capital intensity. Again, this is very bullish for free cash flow, because this tells you that they don't need to invest a lot to generate growth. So CapEx as a percent of revenue is very small at 1.7%. CapEx spend has been pretty much flat to down over the last 4 to 5 years. And then the contract value is important too, because this is, again, telling us the backlog, and the backlog just continues to grow. So even though they only reported, if you go back to the first slide there on this page here, the global contract value, CV, is 4.9 billion, of which they booked 1.5 billion in Q1 of this year. Again, this tells you the total value of all commitments by their clients. But they can't yet book all of that as revenue until they deliver those services to those clients. But this tells you that there is still a big backlog of revenue just waiting to be realized. And so that will ultimately flow through to the bottom line. And it's very important to track how this number is going. And this number continuously expands. So as long as these numbers are continuing to grow at a healthy rate, it doesn't really matter. The 4.5% revenue growth that we saw that disappointed investors, that's not a big deal. That's just them working through their backlog. That it might have been a short-term delay. It could have been just them taking a little bit more time to deliver their product or service to their customers. But again, this 4.5% revenue growth, which is a slowdown, doesn't concern me one bit, because you can see that global contract value continues to increase at a healthy pace. That's been at a 10% CAGR. So I believe that this is the true measure of growth. Even though revenue has slowed, global contract value has not. So that's the analytically relevant number to watch on. So again, these are two of my favorite companies. We just added them to the portfolio. I love both of them. They're excellent. The case with Gartner is that there is a little bit of multiple compression going on. It does trade at slightly a rich multiple, as we see here, 35 times, versus GIB or CGI at just 17 times. So CGI has much lower expectations built in. But I often think that that's where big returns can come from, because trades at a very reasonable multiple and yet still has steady growth in earnings. Whereas Gartner is a much higher multiple. It trades more along the lines of tech. And so that's why the market didn't like it very much, that they only grew the top line by 4.5%. But I think that's just a short-term re-rating. In the long run, it's going to be very healthy and stable, as long as this total global contract value continues to expand at a healthy pace, and that's going to continue for the foreseeable future, given how strong of a brand and how strong of a offering that Gartner has for their clients. So hope you found that helpful, everyone. Again, I'd love to hear from you if you have any questions or feedback. You can reach us directly here at zrs@zacks.com, or Advisor Tools clients. You can send us an email to zat@zacks.com. All right, thanks everyone. Take care.